Hello there, Dana here with your options trading recap for the week of March 24th. This week, we had an opportunity to trade the gap fill down strategy. So we're going to walk that through today. On your screen, you see SPY, which is the S&P 500 ETF. It is currently on the day time frame, and that means each candlestick represents 1 day of price data. When this week opened on March the 24th, it created a gap and therefore a potential trade for us. How do you know it's a gap? You will subtract the open price, or you will take the open price from Monday and subtract the highest price from the previous trading day, which was March 21st, and that gives us a $5.91 gap. Probability suggests that the price of SPY will decrease to fill that gap, meaning the price from March the 24th will decrease back down to at least the highest price of that trading day on March the 21st. So you could enter this trade on March the 24th. I didn't this particular time. I entered on the next day, March 25th. This all depends on your rules. If you entered on the previous day, you would, of course, just need to calculate what strike price. I always buy in or near the money for a gap fill, and I calculate how much that I am willing to pay for the contract. So I entered on March 25th, purchased contracts, a 575 put that expired on March the 27th, at an average of about $258 per contract. Let's keep going. The next day, March 26th, you see we had a nice move down. As we talked about, this trade suggests, or the probability suggests, that SPY will decrease to fill that gap. You'll see that we didn't fully fill the gap. So now you have a question based upon your trading rules. Do you continue to hold the trade, or do you exit with the profit that you have? For me, it's relevant that my contract expired the next day, March the 27th. At this point, I was already in a nice profit. So at this point, these contracts were selling at about $775 per contract, and you can do that math. That's up about 200% return on investment, or 200% return on investment, or over $517 per contract. So the takeaways here, what are your trading rules? How long are you willing to hold a contract? Remember, you need to take into account theta. Theta is your time decay. I don't think anything is necessarily wrong with holding the contract until the day it expires, but my rules, I do not. I trade more conservatively. And if I'm in 200% profit before my date of expiration, I want to take that profit. So stick to your rules, plan your trade, your entries, your strike price, how much you're willing to pay, as well as your exit rules. I hope this has been helpful to you. Until the next time, take good care. Goodbye.